Margin call scandal explained like your September 5th, 2008. A young analyst opens a spreadsheet. 30 minutes later, he realizes his company might be bankrupt. A few hours later, the entire financial system is on the verge of collapse. And by the next morning, some of the biggest banks in the world are desperately trying to dump hundreds of billions of dollars onto anyone willing to buy them. This sounds complicated, but it's actually surprisingly simple. Imagine you're 5 years old and your lemonade stand is about to explode. Let's begin. Imagine you own a cookie shop. Every day people come in and ask for cookies. Some customers have money, some don't. Normally you'd only sell cookies to people who can pay. Pretty straightforward, but one day you have a brilliant idea. What if I sell cookies to everyone, even people who can't afford them? What could possibly go wrong? So you start handing out cookies on credit. No money? No problem. No job? No problem. Already owe money everywhere else? Still no problem. Take the cookies. We'll figure it out later. At first it looks genius. You're selling more cookies than ever. Business is booming. Everyone thinks you're a genius. Your neighbors think you're a genius. Investors think you're a genius. Even your grandma thinks you're a genius. The only problem? Half your customers were never going to pay you back. But that's okay, because you have another brilliant idea. Instead of keeping these risky I owe us, you bundle them together. Then you sell them to someone else. Congratulations. You've just invented a mortgage-backed security. In the real world, banks weren't selling cookies. They were selling mortgages, home loans. And many of those loans were being given to people who probably couldn't afford them. But banks didn't care, because they weren't planning to keep the loans. They were packaging thousands of mortgages together and selling them to investors. Think of it like making a giant mystery sausage. Some ingredients are good, some ingredients are terrible, but once everything gets mixed together, nobody can tell what's inside. Hey, this sausage contains rotten meat. Sure. But it also contains good meat, so let's call the whole thing premium quality. Brilliant. That's basically what happened. Wall Street bundled good mortgages together with bad mortgages. Then they sold them as safe investments. And here's where things get really crazy. The rating agencies looked at these bundles and said, "Looks good to me." The highest rating possible. As safe as government bonds. Except they weren't. Not even close. But investors trusted the ratings. Pension funds bought them, retirement funds bought them, banks bought them, governments bought them. Everyone wanted a piece, because everyone believed housing prices could only go up. After all, what could go wrong? Then housing prices stopped rising, and suddenly everything started breaking. People who could barely afford their homes started missing payments. Then more people missed payments. Then even more. The problem was that all these mortgages had been bundled together. When one failed, it hurt the entire package, and when thousands failed, the entire system started shaking. Now let's talk about the movie Margin Call. The film follows a giant investment bank during one terrifying night in 2008. The company has spent years buying and selling mortgage-backed securities. They're making billions. Everyone is getting rich. Then one day the company decides to fire a senior risk manager named Eric Dale. His job was simple. Find danger before it destroys the company. Unfortunately, they fired him before he finished his work. As he's leaving, he hands a USB drive to a young analyst named Peter Sullivan. "Take a look at this. Be careful." That's all he says. A few hours later, Peter opens the file and discovers something horrifying. The company is sitting on a mountain of toxic assets, hundreds of billions of dollars worth. The numbers don't work anymore. The models don't work anymore. The assumptions don't work anymore. Everything is broken. Imagine owning a house worth $1 million, but overnight you discover it's actually worth $700,000. Not great. Now imagine you borrowed $950,000 to buy it. Now you're in trouble. Now imagine doing that with hundreds of billions of dollars. That's what the bank had done. They borrowed enormous amounts of money to buy mortgage assets. This is called leverage. Leverage is like using a tiny ladder to reach something very high. It works wonderfully until the ladder slips. Then you fall very hard. The bank had pushed leverage to the limit. If their assets dropped slightly in value, they were finished. Peter reruns the calculations. Same result. Runs them again. Same result. Runs them again. Still the same result. The company is effectively doomed. Soon executives start arriving, senior managers, department heads, risk officers. Eventually, the CEO himself arrives by helicopter. Because apparently that's how financial disasters work on Wall Street. Everyone gathers around a conference table. Peter explains the situation. Very carefully, very slowly, like he's explaining it to a child or a golden retriever. Sir, we've been buying mortgage assets. We've borrowed huge amounts of money to buy them. If these assets fall by 25%, the losses will be larger than the entire value of our company. The room goes silent, because everyone understands what that means. Bankruptcy, not eventually, not someday, immediately. The CEO asks the obvious question, what do we do? And that's where the scandal begins. One executive proposes the only solution that can save the company. Sell everything, immediately, all of it, every toxic asset, every mortgage security, every piece of the bomb, dump it into the market before everyone else realizes it's worthless. There's only one problem. They know it's worthless. They're selling something they believe will collapse, to people who don't know that yet. One executive objects. If we do this, we'll destroy the market. Another points out something even worse. We'll be selling to people who trust us. Friends, clients, partners, institutions we've worked with for years. The CEO listens, then makes his decision. Sell it all, tomorrow morning, at any price. Because if we don't survive, nothing else matters. The next morning is brutal. The traders arrive, usually they're loud, confident, cocky. Today they're silent. They know what's happening. Their mission is simple. Unload everything before the market figures it out. So they start making calls. Hey buddy, I've got a great deal for you. Want some mortgage securities? Huge discount. Fantastic opportunity. Meanwhile, the buyers don't realize what's happening. They think they're getting bargains. They're actually buying financial grenades. As the day continues, rumors spread. Prices begin falling, then collapsing, then completely imploding. The market realizes something is wrong, very wrong, and panic begins. By the end of the day, the bank has sold most of its toxic assets. They survive, barely. But the damage spreads everywhere else because those toxic assets didn't disappear. They simply changed owners. This is why the movie is called Margin Call. A margin call happens when you've borrowed too much money and your investments lose value. Your lender demands more cash immediately. If you can't pay, you're forced to sell. The problem in 2008 was that everyone was leveraged. Banks, funds, investors, everyone. So when prices started falling, everyone tried selling at the same time. And when everyone runs for the exit simultaneously, there is no exit. The movie itself is fictional. The characters aren't real. The bank doesn't have a real name. But the events are based on what actually happened during the 2008 financial crisis. And the consequences were devastating. Millions of families lost their homes. Millions lost their jobs. Retirement savings vanished. Entire neighborhoods were filled with foreclosure signs. Trillions of dollars disappeared. Then came the most controversial part. The government stepped in. Instead of letting the banks fail, they bailed them out. Hundreds of billions of dollars. Many ordinary people were furious. The institutions that helped create the crisis were being rescued, while regular families were losing everything. Even today, it's one of the most debated decisions in financial history, and that's the real lesson of margin call. The crisis wasn't caused by one bad person or one bad decision. It happened because an entire system convinced itself that risk had disappeared. Everyone trusted the models. Everyone trusted the ratings. Everyone trusted housing prices. Nobody wanted to ask hard questions while the money was flowing. Then reality arrived. And reality doesn't care about spreadsheets. The scariest part? The people involved weren't cartoon villains. Most genuinely believed the system would keep working. Until one analyst opened a spreadsheet and discovered otherwise. A single file, a few calculations, and suddenly the biggest financial machine in the world looked like a house of cards. That's Margin Call explained like you're 5. If you enjoyed this breakdown, make sure to like the video, subscribe to the channel, and leave a comment below. Do you think the banks were victims of a broken system, or did they knowingly create the crisis? Let me know what you think, and I'll see you in the next video.